clearly financial markets remain absorbed by the big picture issues at the moment relating to Europe. We have just completed the latest EU summit. It was placed as the most important EU summit in the history, but we've had 7 so far this year, and the conclusion that can only be drawn from each of these summits is that there's no radical action that can take place. This is just really consolidating the austerity measures that are required in Europe and bringing Europe together, and naturally that is causing all sorts of issues, concerns for respective nations. Financial markets therefore observe a lot of this. In fairness, I think financial markets have remained relatively stable in light of these conversations taking place between the various leaders at the moment, and we'll reflect that in a few of the charts. But one of the issues that I think does come across is that where we do see some asset price swings, and in particular in relation to sovereign bonds, it's surprising how much markets seem to take on trust on words that ultimately don't come to much. And we'll see this in the first chart, I think, with regards to Italian bond yields. We've been talking about this chart now for a few months, and it has become a dominant feature of financial sentiment. And this rise here from 5% to 7% took place over a period of just 3 months, but turned a country from a safe position to one that was right at the forefront of the financial crisis. Now, this very, very sharp move down that we saw, taking yields back from 7.5% to sub 6%, really coincided with comments that we saw from the leaders in France and Germany, which gave the impression that the ECB may have the cover of greater austerity within Europe to increase its bond buying programme. And the market took heart with those comments, expecting to see at this EU summit some real commitment from the ECB that they would come into this market as a lender of last resort. You can see that sentiment lasted approximately 48 hours before Draghi came out, the leader of the ECB. He did 2 things. He only cut interest rates by 1/4 of a point. I think the market could have done with 1/2 a point or even 3/4 of a point to show the commitment, but only 1/4 of a point there. And in fact, the comment was that they didn't even discuss 0.5%. But secondly, that he made it quite clear that wasn't going to be his job to be lender of last resort. And you can see there that this yield on Italian bonds has snapped halfway back, and my suspicion is it will possibly go higher with a lack of resolution to that issue. Now, what has this done to the financial markets? Well, let's just take a look at the currency, because one feature that I think is beginning to trend here is euro weakness. It's slowly coming. In fairness, I think participants may well have expected a weaker euro than we've had, but money is still quite tight in dollars, as we saw in the previous week when we had that move by central banks around the world to flood the market with dollars. We are short of dollars around the world. So dollar strength here and euro weakness is beginning to trend, and we're seeing prints below 133 on the dollar, and so it may be something that trend looks to be in place now for weaker dollar going forward. In fairness, it's possibly what it needs to retain some competitiveness in Europe at the moment, particularly for those southern Europe states that have struggled with that higher currency. I want to just look at the stock markets, because stock markets, in fairness, haven't performed too badly. And with apologies for being slightly technical about it, but we've drawn a line here, which is the 200-day moving average, because at certain points this week we have been sort of nudging towards this 200-day moving average, which a lot of technical analysts treat as a pretty key aspect to judging levels on markets, whether we break higher above the 200-day moving average or whether it proves resistance. Well, so far it looks like it's proving to be the resistance rather than the support level. This is the FTSE 100. We didn't quite meet that level. We had a little look at 5,600, but have shied quite quickly away from it. But if we take a look at the US market, this is the S&P again. That level really sort of just touched on early on the midweek morning, and that predicated a sort of little bit of a sell-off, which coincided with disappointment around this EU summit. But technicians are looking at that level. And I do want to just turn back to equities, because despite all of the problems problems that we face in Europe, there are many businesses that continue to do very well. And I just want to sort of paint a handful of pictures here of stocks that over the last 2 or 3 years have carried on virtually regardless of the macro issues. And you can always find that in the equity market. That's the thing that we do try to point out, that everyone's not tarnished with the same brush. Let's just take a look at Glaxo. It's been a long-term underperformer, but this is now a 3-year chart, and you can see that actually it is building some momentum. The healthcare industry is benefiting from money cycling back into defensive names, and companies like Glaxo that have for the last 10 years been worried about the patents that are running out of their particular life have proved to be underperformers. But I think a growing sense that these companies will do well in the new developing markets of the world has sort of just begun to change sentiment towards the healthcare sector. So it's a slow process, and there's nothing sort of lively about this chart, but it just feels to me like a trend of relative strength there in healthcare, in the healthcare market. And let's just flick through other charts that I think have got businesses that are doing well despite. Next is a company, the retail sector has been virtually shot to pieces in many places. We saw Barrett's go down this week for the second time in administration. Well-run organisation with the directory and the internet sales is happily migrating towards new technology, and Next is doing very well. These are all FTSE 100 companies. This one is Tate Lyle. Tate Lyle morphed out of a raw materials provider of sugars into much more added value services with good management. And again, this is a 3-year chart, and there you see absolutely no problem with that share price performance, continuing to nudge new highs. Similarly with Associated British Foods, that sort of actually sit quite comfortably in the raw materials market and retail. Again, that chart under no pressure despite all the macro issues. And the final one from me is Compass Group, that supplies food on an outsourcing basis. It's demonstrated amply that outsourcing has been able to navigate its way through difficult economic conditions as well as good economic conditions, and therefore Compass remains very much on our buy list.